Hey everyone, welcome back to the channel. Today, we're diving into a powerful income-generating strategy that's been gaining popularity, covered call ETFs. If you're looking for a way to boost your portfolio's income, even during market volatility, this video is for you. So, sit back and relax, and I'll take just a few minutes to break it all down. So what are covered call ETFs? Well, covered call ETFs are a type of exchange-traded fund that uses option strategies to generate additional income. Specifically, these funds sell call options on stocks they already own. This is called a covered call strategy. Here's a quick history lesson on covered call ETFs. While covered call writing has been around for decades, covered call ETFs started gaining traction after the 2008 financial crisis, when investors sought lower-risk, income-focused strategies. Now here is the basic concept on how they work. The ETF holds a basket of stocks, often from a major index like the S&P 500 or NASDAQ 100. The ETF sells call options on these stocks, agreeing to sell the stocks at a set price if they rise above that level. In return, the ETF collects a premium cash from the buyer of the option. This is income for you as an investor. Here's a step-by-step breakdown on generating income through call options. Let's walk through the process in simple terms. Step 1. The ETF buys stocks like Apple or Microsoft. Step 2. The ETF sells a call option on those stocks. Step 3. The ETF collects an option premium, income, for selling that option. Step 4. If the stock price stays below the option's strike price, the ETF keeps the premium and the stock. Step 5. If the stock price rises above the strike price, the ETF might have to sell the stock at that price, limiting its upside gains. Let's look at a simple example to illustrate the concept. Imagine the ETF holds 100 shares of Apple, currently trading at $150 per share. The ETF sells a call option with a strike price of $160 for a premium of $5 per share. If Apple's price stays below $160, the ETF keeps both the stock and the $500 premium. If Apple's price rises above $160, the ETF sells the stock at $160. It misses out on gains above $160 but still keeps the $500 premium. That premium is the extra income that gets distributed to investors like you. Why do investors like covered call ETFs? It comes down to income plus stability. You see, there's higher income potential. The option premiums collected are paid out as distributions, leading to higher yields compared to traditional dividend ETFs. It's a hedge against volatility. During market downturns or sideways markets, the premium income can help offset stock price declines, providing some cushion during uncertain times. And there's diversification. Covered call ETFs hold dozens or even hundreds of stocks, so you get broad market exposure while benefiting from the covered call strategy. Is there a downside? Yes, it could limit your upside gains. If the stock price soars above the option strike price, the ETF must sell the stock, and you miss out on those big gains. Covered call ETFs are best suited for investors who prioritize steady income over large price gains. You need to know what you're investing in. Option strategies can be complex, and covered call ETFs simplify the process for investors. However, it's still important to understand that options involve risk. Before investing, take time to learn how options work and review each ETF's specific approach. So what about tax considerations? Options premiums and dividends may be treated differently for tax purposes. Some distributions could be taxed as ordinary income, which might be higher than qualified dividends. Always review a fund's tax information and consult a tax professional if you're unsure. What are some popular covered call ETFs that you can research? Here is a short list of some well-known covered call ETFs. Let's start with the Global X S&P 500 Covered Call ETF XYLD, also the Global X S&P 500 Covered Call ETF QYLD. Then there's the JP Morgan Equity Premium Income ETF, JEPI. Or how about the JP Morgan NASDAQ Equity Premium Income ETF JEPQ? Finally, the NEOS S&P 500 High Income ETF SPYI is another popular covered call ETF. Each ETF has slightly different strategies and income levels, so compare these or others to find the right fit for your portfolio. So let's recap what we've learned. Covered call ETFs generate income by selling call options on stocks they hold. They offer high yields and can reduce volatility, but they limit upside potential. These ETFs simplify option strategies, but understanding the risks is crucial. Tax treatment may vary. Be informed before investing. What are your thoughts on covered call ETFs? Have you invested in XYLD, QYLD, JEPI, or any others before? Do you prioritize income or growth in your portfolio? Let me know in the comments below. I'd love to hear your strategy. I'm not a financial advisor, and this video is for information only. Before investing, do your research and consider speaking with a financial advisor. Covered call ETFs can be a fantastic income tool, but they aren't right for every portfolio. If you found this video helpful, hit that like button and subscribe to the channel for more investing content. Thank you so much for watching. I'll see you in the next one. Until then, invest smart and keep building your future income. Thanks again.